Hello, everybody, and welcome to today's webinar, our Fiduciary Wealth Management series of webinars. My name is Matt Penfold, and today I will be talking about the differences between the Portuguese investment bond and the Qnups, and which is best for you. So I'll be covering some of the features today, but a bit of an early spoiler for you, which is best for you. We would not be answering that question today. There's a very simple reason for that, and a very good reason for that is that there isn't a one size fits all approach for either of these. For some people, one may be suitable. For some people, the other, maybe a combination of the two, maybe other products as well. So today we just want to talk about the features and urge you to reach out, contact us, and we can talk you through that in a more depth, assess your situation, look at what you're trying to achieve and help you get there. So a quick introduction before we start. So yeah, Fiduciary Wealth Management. We're based here in Gibraltar, but we cover Gibraltar, Portugal, Spain, and the UK. They're our main markets. And you may think, well, you're there living in Portugal. There's a lot of advisors there. Why don't you use one of the many advisors there rather than someone based across there in Gibraltar? Well, there are a few reasons for that. Firstly, and I must add, all our advisors here are regulated to give advice in Portugal as part of our membership of a regulated EU network. We're also regulated here in Gibraltar, and we're authorized to give advice in the UK. So we operate on a UK style system with knowledge and services to the expat community in Portugal. So really the best of both worlds. You benefit from a company that has robust regulation and compliance, with also access to all those products in Portugal that you may have heard about. So we're diving into the webinar, and I'll try to run through this as concisely as possible. Again, I won't have all the information today, but that's not the point. We're here to introduce these products to you and really introduce ourselves and see what happens following that. So we'll talk about the taxation because that's very important shortly, but let's just see what are they. So the Portuguese investment bond. So when we relocate from the UK, ISAs, for example, and other tax efficient products are no longer valid. The Portuguese investment bond has effectively been called the closest thing to the ISAs in Portugal. It's tax deferred, which we'll cover shortly, but it's effectively a wrapper around a portfolio of assets. A Qnups is a pension. It stands for Qualifying Non-UK Pension Scheme, but it's not a pension as you and I may know them from a traditional pension, which is you make contributions, your employer might make contributions, you get tax relief. A Qnups is funded for a lump sum investment, the same way as a Portuguese investment bond, and that's why we're comparing the two products here today. So you may have sale of property in the UK, investment portfolio, sale of business, other assets. That would be a kind of perfect example of you've got this lump sum. Where do you find somewhere to invest tax efficiently? And you may also be thinking, well, I've in NHR in Portugal, that's very tax efficient. If you have gained NHR status, that's great. But the big missing point from NHR is capital gains, and capital gains tax in Portugal is very high at 28% with no allowance. So if you've got investments, ISAs, whatever in the UK or elsewhere, 28% you'll be paying on those gains within NHR or after NHR. So it's something that you really need to kind of plan and look at. And this is maybe where these products can come in and help you out. So with both of them, when we talk about capital gains, there are no taxation, no capital gains or anything until you access the capital. So invest the money, you leave it to grow in value. There are no annual taxes to pay. That's the same for the Qnups and the Portuguese investment bond. So it's a score draw for that. So I hear you ask, so what happens with the taxation? When do I pay tax? So I'll cover the Portuguese investment bond firstly, and I will share my screen for this one. So because we talked about the tax rate of 28%, and the longer you hold the funds in the Portuguese bond, you can reduce that tax rate. So you see that diagram there. So in the first 5 years, 28%. Between 5 years and less than 8 years, 22.4%. More than 8 years, 11.2%. So if you've got some capital that you're planning to hold on to, if you can invest that or not access it for 8 years, you reduce that capital gains down to 11.2%. Now, also, we mentioned that it benefits from tax deferral. So what that means is you don't pay capital gains until you access it. And when you access the money, you only pay tax on the gain element of the withdrawal. There's a diagram here which demonstrates that very clearly. I won't talk you through it and waste your time. You can watch this back and pause on that screen and go through it. But effectively what it's showing is somebody makes a withdrawal after the 8-year period because they're only paying tax on the gain. The tax is actually paid by the bond provider directly to the tax authorities as well. That saves you that. We've got an effective tax rate there of 3.73. You can see that in the box at the bottom there. So for the Qnups is a pension. So it's taxed as pension income. So if you're are in the NHR, you think, okay, 10%. Outside NHR, you pay it at normal income tax rates. The higher your income, the more you pay. But there is a bit of a caveat there. In Portugal, because it's an investment product, they can't identify what is return of capital and what is a gain, but they only want to tax you on the gain element. So as long as it's structured properly and managed in the right way, you will only pay tax on 15% of the withdrawal. So you take a sum of money, 15% of that is taxed, and then the tax rates apply. So for example, if you're within NHR, 15% of the withdrawal is taxed at 10%. So your effective tax rate is just 1.5%. Very low, very tax efficient. When you're outside of NHR, it depends what your income tax rate is. If it's 20%, then you're going to be paying tax at 3%, which again, very tax efficient. Bear in mind, you haven't been paid any capital gains tax on the growth within that. So what about the providers? Who supplies these products? So we act as the advisor. We give you the advice, make sure everything's set up properly, continue our relationship with you for a long time. If you're interested in the relationships we have with our clients and how the clients view them, please look up our testimonials on Trustpilot. We have video testimonials on our website, which is fiduciarywealth.gi. But the products are provided by the third parties. So for the Qnups, this is a pension. They're not based, the pension providers aren't based in Portugal. Generally, we want to use a provider in Malta. They have a double taxation agreement with Portugal. So there's 0% tax from the Maltese end. So you just pay that tax in Portugal. So maybe that 1.5 that we talked about. For the Portuguese investment bond, there's a very, very limited supply out there. There's really only kind of one provider out there. So you will see the same name coming up again. That's reality. They have to set it up. The policy has to be approved by the Portuguese tax authorities. So they dominate this market. So with the Portuguese investment bonds, which provider to use isn't the question. The question is, how are you paying your advisor? Because there's a very important point here. So when you have a Portuguese investment bond, the product provider allows the advisor to be paid by the client in two separate ways. The first one is on a fee basis, or what they call a 100% allocation basis. This is how we set it up. This is how it should be set up. What that means is 100% of your investment goes into the bond. Then you agree the fee that you pay to the client, pay to the advisor, then it is paid. Very clear, very transparent. With a commission basis, the advisor can be paid a commission hidden away a little bit in the back there and we've seen payments of 7, 8%, even higher, 10, maybe even 12%. And the advisor, and I've seen this before, somebody has told me that they said this, will say to the client, "You're not paying us, the bond provider is paying us." That sounds a little bit too good to be true, doesn't it? So what effectively happens is the bond provider does pay the advisor. They pay straight up front, 8, 10%. That advisor thinks, great, what a payment to me. I'm going to move on to the next guy. But of course, that bond provider isn't doing that out of their generosity. They take the money back off you as a client. So you have this large bill to pay. So you're paying these huge fees every year. And because you've got to pay that money back, you are tied into that bond for 8, 10 years, whatever the period. That should never be structured like that. It should be on a fee basis. In the UK, fee basis only. Commission payments are outlawed. Unfortunately, in the offshore market, commission payments are still allowed. But our advice to you would be, if you're speaking to someone and they say the commission basis, walk away. Never deal with those people. Even if they will say to you, well, you had the choice, fee or commission basis, walk away. They shouldn't consider doing that. It's not the ethical way to do that. It should be on a fee basis only. So the next point really is a very important point, and this is inheritance tax. So there are two different consider. We've got inheritance tax, and then there's kind of Portuguese succession tax, which we can discuss with you on an individual basis. It depends who your beneficiaries are, the size of your estate, but Portuguese succession tax isn't as draconian as UK inheritance tax. If you're passing on to your next of kin, generally you won't have to pay anything. But UK inheritance tax is the problem. And there's a common misconception that we think, right, we relocate from the UK, we're now a Portuguese tax resident or elsewhere, we're not a UK tax resident, therefore we're not liable to UK inheritance tax. That's not true at all. UK inheritance tax is based on your domicile, not your tax residency. Our domicile, we tend to acquire it at our birth, and it's difficult to shake up. Even if you've been out of the UK for many years, you need to be out a substantial amount of time. You need to establish a permanent base elsewhere. You need to cut off all ties with the UK, even small ones. And it's very difficult to shed your domicile. And there's no test to assess this. HMRC will never tell someone, okay, you've lost your UK domicile. So our advice is always to plan for the worst. And the good news is that as an expat, there are opportunities to plan against UK inheritance tax. The Portuguese investment bond is not one of those, but the Qnups is. Okay, so because the Qnups is a pension, it is outside of your estate for UK inheritance tax, but only if it's set up as a genuine retirement plan. So what we mean by this is the amount you invest has to be in line with your overall net wealth, your age, and your income requirements. So to use a practical example, we have an individual come to us. They've just moved to Portugal. They're 75 years old. They've got an overall net wealth of, say, 3 million euros. And they say, yeah, I acknowledge I've got a UK inheritance tax problem, but this Qnup sounds amazing. Let me put 2.8 million euros in the Qnups and say goodbye to UK inheritance tax. That would not work because it's clearly a UK inheritance tax fudge. But if you have someone who's able to plan earlier or invest a smaller proportion of their overall net wealth in the Portuguese bonds, then it can work. So it's important to assess that, get the right advice to make sure the amount that you are investing ticks all those boxes. And again, that's why it's important to align with an advisor who understands the products, understands your situation, is working with you to find those solutions. So there we go. That's a brief overview of the Portuguese investment bond and the Qnups. I reiterate what I said earlier today. This is just an outline. We're in the business of providing solutions to people. but we need to understand your whole situation, what your issues are, what your goals, what your plans are, and we can help work with you to put a plan together that may involve a Portuguese investment bond, that may involve a Qnups, it may involve neither. But if you are intrigued by this, shortly I will be putting our contact details back on the screen, and you're more than welcome to reach out to us. Just below, I think at the bottom of this webinar, there's my personal email. Feel free to reach out to me as well, and we'll be happy to have a free, no obligation chat with you about this or any other situation. And this applies if you're newly tax resident in Portugal. Maybe you're planning to relocate to Portugal. It's very important to plan as early as possible so we can have that conversation with you now. Or even if you've been in Portugal for some time and you might have a pension, you might have a bond, and you want to assess if these are set up correctly. Maybe the performance of your investments isn't what you quite expected. In that situation, we can offer a no obligation second opinion to go over those with you. So hopefully there's enough there that you're well aware that we're in a position here that we want to help you and we can help you as well. So let me bring up our contact details on the screen there for you. There you go. So it's fiduciarywealthmanagement.gi is our website. You can always find us on YouTube as well, plenty of videos, testimonials, and you can get a better flavor of who we are. Feel free to look us up on Trustpilot as well, Fiduciary Wealth, for some independent reviews of who we are. And you can contact us there on inquiries with an E at fwm.gi, or call us directly on 00350 200 50982. Well, my name's Matt Penfold. It's been a pleasure talking to you today. I hope the webinar has been of some use. There'll be more webinars, so keep a lookout for those. But for now, I will wish you a lovely rest of the day. I hope to hear from you shortly, and I look forward to those conversations. Goodbye.